All right, let's jump right in. Today, we're talking about one of the biggest investment stories out there right now, the decarbonization of heavy industry. This is a massive, multi-trillion dollar shift happening under our noses. And to really get our heads around it, we're going to follow the money, starting with the material that literally built our modern world, steel. So let me ask you a question. What does $800 million actually get you? Well, in this case, it might just be the price to save a single company in an industry that many thought was dying. So why are governments all of a sudden writing checks this big for something as old school as making steel? Well, it's a huge bet on technology, on jobs, and on national security, all wrapped up in this global push for a greener future. So here's our game plan. First, we're going to unpack this billion-dollar bet on British steel to really understand what's at stake. Then we'll get into the core technology that's forcing this huge change. After that, we'll walk through what I'm calling the investor's gauntlet, all the risks you'd have to navigate. Then we'll zoom out and build a framework you can use again and again. And finally, we'll connect the dots between this industrial revolution and the digital one, which, believe me, reveals a pretty surprising opportunity. Okay, so let's get into it. The whole story really kicks off with these enormous government support packages for the UK's two biggest steelmakers, British Steel and Tata Steel. But there's a huge catch. They have to ditch their old, dirty, carbon-intensive technology to meet these new net zero laws. And let's be clear, this isn't just a simple upgrade. This is an attempt to completely reinvent a legacy industry, and they're doing it under some serious pressure. Now, to really get why this bailout is such a big deal, you've got to look at the history. This isn't just any industry. Britain basically invented the modern steel industry, dominating the entire world back in 1875. But just look at this timeline. It's been a century of turmoil, nationalization, privatization, brutal global competition that has just brought it to its knees. The workforce has absolutely collapsed, from a peak of 320,000 people down to just 30,000 today. It's this dramatic fall from grace that sets the stage for today's high-stakes gamble. Right, so this government money isn't just a handout, it's forcing a technological showdown. At the absolute heart of this whole transition is a fundamental clash between the old way of making steel and the new way. And this slide really gets to the core of it. On the left, you've got the old school blast furnace. You feed it raw iron ore and coal, you burn it incredibly hot, and you get what's called virgin steel. The problem? It's labor intensive and it pumps out a ton of CO2. On the right, you have the new kid on the block, the electric arc furnace, or EAF. This thing takes scrap steel, melts it down with a massive jolt of electricity, and recycles it. It's way cleaner, it's more efficient, and it requires far fewer workers. And that last point, that is a huge source of political tension, because efficiency often means job losses. Okay, but this brings up a really critical question, right? Especially if you're an investor betting on this new tech. If you're just recycling steel, does that mean it's weaker? The fear is that a country might lose its ability to make that high-quality, virgin steel for things like national defense, and that could be a potential deal breaker for everybody involved. But you know what? The facts just debunk that whole idea. The notion that recycled steel is automatically weaker is just outdated. The source material points out that some of the most critical, high-strength steel on the planet, we're talking aircraft landing gear, even nuclear submarines, is already being made in electric arc furnaces. This isn't just for patio furniture. This is top-tier, mission-critical stuff. The technology has just moved on, and the quality argument is pretty much a myth at this point. All right, so the technology checks out. It's solid. But hold on, before we get too excited, it's time to put on our investor hats. Because great tech is one thing, but a great investment is something else entirely. We have to run the gauntlet of all the fundamental business risks that come along with this government-forced revolution. Before we get wrapped up in the green angle or the free government money, we have to ask a really brutal question. Is making steel in the UK a fundamentally sound business to begin with? Because at the end of the day, if the core economics don't work, no amount of subsidies is going to save an investment. And when you start digging, the picture gets pretty challenging. First, there is a global steel glut. The world is just making way more steel than it needs, and that crushes prices for everybody. Second, you're up against these heavily subsidized foreign giants. Third, this specific company, British Steel, has a really shaky past, including a recent bankruptcy and something called a qualified audit opinion, which is a huge red flag. It basically means the auditors literally could not verify the company's inventory. And finally, look at the subsidy itself. It is enormous on a per-job basis. This is not a healthy-looking industry. And if there's one chart that shows the UK's single biggest problem, it's this one: electricity. These new green furnaces are incredibly power hungry. They're going to double the industry's energy use. And yet, look at this chart. Wholesale electricity prices in the UK are more than double what competitors in France or Spain are paying. How on earth can you compete globally when your main fuel cost is twice as high as your rivals? It's a massive, massive disadvantage. Okay, so the business case on its own looks pretty weak. But then comes the trump card, right? The national security argument. This is the one that always gets pulled out to justify subsidies. The idea that a nation absolutely needs its own steel for tanks, for warships. It sounds really convincing, but does the data actually back it up? Well, the data just completely takes this argument apart. First off, the UK's virgin steel industry isn't self-sufficient at all. It completely relies on imported iron ore and coal. Second, the country is a huge exporter of the scrap steel that these new furnaces need. So switching to recycling actually makes the country less dependent on foreign supply chains. And finally, defense is just a tiny fraction of steel demand anyway. When you really look at it, the national security case just kind of falls apart. And the final risk is maybe the biggest one of all: obsolescence. The economist Joseph Schumpeter had this amazing phrase for it: creative destruction. It's that constant process where new technology just makes the old stuff irrelevant. Think about how smartphones completely destroyed the market for digital cameras. So while electric arc furnaces are the future today, what's next? When you're making a 30-year bet on a factory, you have to remember that a better technology could be just around the corner, making even today's green steel obsolete. That's a risk no investor can afford to ignore. Okay, so we have gone deep into the weeds on steel. We've looked at the history, the tech, the serious risks. But here's the thing. The goal wasn't just to understand one industry. The real value here is to use this case study to build a powerful, repeatable framework. So let's zoom out and see how the questions we just asked about steel can be applied to any major investment theme, whether it's AI or biotech or anything else. The best place to start is always with a top-down approach. I want you to think of it like a funnel. You don't just start by randomly picking stocks. First, you get a feel for the whole market. Is the tide rising for all boats, or is it falling? Then you figure out which of the 11 major sectors of the economy are showing the most strength. From there, you drill down into specific industry groups to see what's leading the charge. And only at the very end do you start looking for the best individual companies. This whole process just systematically stacks the odds in your favor. And this slide makes that framework really practical. These are the 11 sectors we were just talking about. And the cool part is you can easily track them using something called ETFs. They're basically funds that trade like a stock. So our green steel theme, it falls into two of these: industrials, which has the ticker XLI, and materials, ticker XLB. By just watching those two ETFs, you can get a really good sense of whether big money is flowing into this theme or away from it. Now, once you've used that funnel to find a specific company, you run it through these 4 final checks. Pillar 1, fundamentals. Is the company actually healthy? Is it profitable? Is it drowning in debt? Pillar 2, technicals. This is all about what the market thinks. Is the stock price trending up, showing confidence, or is it falling? Pillar 3, cash flow. How can this investment actually pay you? Does it offer dividends? And finally, Pillar 4, risk. This brings us right back to our gauntlet. What could possibly go wrong? An investment only gets a green light if it passes all 4 of these checks. All right, now for the really cool part. Let's connect this whole thing to the biggest picture possible. Because this green steel theme, this entire story of industrial decarbonization, it's not happening in a bubble. It's actually colliding with the other huge revolution of our time, and that's creating a much, much bigger investment thesis. I mean, think about it. The artificial intelligence boom isn't just code and algorithms floating in the cloud, right? It depends on a staggering physical build-out, data centers the size of cities, specialized cooling systems, and just gigawatts and gigawatts of electricity. At the end of the day, it's a business of atoms, not just bits. And what's so fascinating is that we see the exact same pattern on the industrial side. To transition steel plants, cement factories, and chemical plants to green technology, it's going to require a monumental investment in new physical factories, new supply chains, and most important of all, a massive upgrade to our energy infrastructure. So what's the common denominator? What's the undeniable link between the AI revolution and the green industrial revolution? It is an absolutely insatiable demand for one thing: power. AI data centers and electric arc furnaces are literally competing for the same electrons. And this points to the real bottleneck, and maybe the real opportunity. The picks and shovels play here isn't just about AI chips or green factories. It's the utilities and the grid infrastructure that make the whole thing possible. And this leaves us with a final, really powerful question to think about. When you have two massive, world-changing revolutions, one digital, one industrial,
and they both depend on the exact same finite resource. Where should an investor really be looking? Is the smarter play on the individual companies, like a specific steelmaker or an AI firm? Or is the true, lasting opportunity in the fundamental infrastructure that has to power them all?